All right, welcome everybody to Midas Investing Live. Hope you're all having a good Saturday afternoon. Make sure up and running or so. I'll start off right off the bat. If you joining us right now, or if you're watching a bit later on replay, it'd be really helpful if you like the stream. Please like the stream. That way we can attract more viewers to the channel. If you haven't already, subscribe to the channel. That way you get notifications whenever I go live or whenever I release any other information. And if you've done both of those things, well, then you should join our free Discord. The link is the pinned comment in the chat as well as in the description below. But join our Discord and be part of our daily discussions of what we got going on in our own portfolios, what's going on in markets, what's going on in actions of our favorite investors or academics and other things like that. So come and be part of our discussions there. It does require manual submission into the group, I will say. So if you join the group initially, you will not be able to really see anything when you first like enter the actual Discord. So you either have to go on to the right hand side and ping or comment or message one of the moderators, which you should be able to see, or just wait about 24 hours and somebody will probably let you in if you haven't said anything at that point. But it's basically just a filter system to keep out spam bots or people who are trying to solicit all sorts of other random services or take you to some other server where maybe they're going to try to scam you or something like that. Because a lot of people will just come into a server immediately and then just start spamming stuff. And if they can't get access to the server, they'll just leave within like a couple of minutes or something like that. So even just waiting 24 hours makes a big difference in terms of like just how much garbage you filter out of those servers. So we have a little bit of a delayed system, but be patient is basically a long way of saying be patient. If you do join the Discord, somebody will let you in within like a day or so like that. If you haven't messaged somebody, but either way, you can join the Discord. It'd be really great. And if you have joined the Discord, I will say in the Discord, there is also this link here on the right-hand side to the free valuation dashboard, which comes over to this one page here where there is this one singular link. And you can click that to go and see the public dashboard, which the public dashboard I revealed a few weeks back at our last live show. This, like I said, it's free access for anybody in the Discord, which the Discord itself is free. You just have to wait for somebody to let you in. So that means that this link here is free to the public. That you can come and get access to this link, which will come here to this one page, which gives you a basic overview of my valuations for all the companies that I have full models for. The companies that are on the list changes from time to time, so don't get too attached to one of those companies unless you're gonna comment and message about it to kind of make sure it's fresh in my mind that people are interested in that company. But nonetheless, if you want to see has Midas changed his valuation on Skyworks in the last 3 weeks? Well, you can just come over to this spreadsheet and you'll see that, oh, it's currently worth $100 according to him. And then maybe next week it's worth 105 because some good news comes out and I change something like that, or maybe not, maybe it's something like that. But point is if you want access to see what I think something's worth out of the companies that I tracked on any given day, because I do change my opinions on things on a regular basis, well, then you can click that link and see what it is. There is also the ability to pay for a premium version of the dashboard, which has more features currently, and then also is being added. If you have one of the paid versions of the dashboard, you can over here, it has these links up here at the top, which takes you to a separate spreadsheet, which has 10 years of the financials for all the companies in that dashboard. So here, this first tab is for Apple. We can see the income statements, the cash flow statements, and the balance sheets for Apple for the last 10 years. We could come over, take a look at Generac. We have Generac's income statements, cash flow statements, and balance sheets. I could take a look at Lulu's income statements, cash flow statements, and balance sheets. And that's just the financial link. There was also the valuation link. So you can click on that, and that would take you to a separate spreadsheet, which has all of the main valuation templates, or at least the kind of like the display page for the valuation templates for all these companies. So here we have Apple, my main valuations for them, the distributions of those valuations. You can scroll down to look at all the core assumptions of them. Likewise, we could take a look at Generac like we did before. Here's the Generac one, all the core assumptions in the valuations below. And then we could also again look at Lulu. So you can pay for access to this one for $5 a month. You can join the Patreon, which is in the link below. You can pay me $5 a month via PayPal. Any method that you want to pay me $5 a month, I'm not picky about it. Whatever is most convenient for you. But if you do so, I will give you your own, basically a private version of the dashboard you'll have access to, which will have these links at the top, which will get you the ability to look all that information as well. And then I am also planning to add some more features to the premium selection here in maybe this week. I'm basically pretty close to done with like kind of setting up the stuff that is involved in that particular new feature, which is to say that I wanted to add kind of secondary uh, dashboards. Here, this is kind of like the main one that has all the companies in my main model, my main list of companies that I've modeled. Like these are all companies that either I have very strong revenue and cost models for, or ones that I was reasonably proud of the work I did in the video that I maybe made for one of those companies here as well. So that's kind of like the companies that are on this list right here. But over the last several weeks, we've been talking about doing a lot of qualitative research on specific industries. I've been doing a very specific research trying to come up with a list of quality assets within like the miner space. Then I also was doing REITs. And then today we're also going to talk a little bit about utilities. And then I have a list of other industries I'm planning to do research on as well. But my goal was to eventually kind of create separate little watch lists for all of the best companies in these industries and sectors that I'm trying to track. So if I'm trying to track gold mines in particular, well, then I can do all that research to come up with a list of what I think are like the top 10 companies in the gold mine space based off of the assets they have, based off of the type of assets or the specific company that they are. And then within that top 10 companies, I can narrow it down to maybe like the top 5 management teams based off of my own research and decisions of what I think is a good management team. And then from there, it can go even further. I can then do evaluations of all 5 or even all 10 of them to then say, okay, well, how is the valuations compared to my assessments of the management, compared to my my quality rating of the companies themselves. And then we've kind of like really narrowed in on what we think are the best companies that in that particular sector. So that's kind of like what I plan to do. So like for here, you can see I've already done that with the gold mines. I have 11 companies here that I've already done some basic valuation work on. So I have some basic values for it. And so you can see I've already kind of taken a look. These are some of those top companies. If I come back over to that research tab, to the miners, so we had Alamos, Evolution Mining, Osisko Gold Royalties, Orla Mining. Seabridge is one that I ended up skipping for a variety of reasons. Goldfields I also ended up skipping. Royal Gold we ended up doing. Eldorado Gold we did. Equinox Gold we did. Metalla Royalties we did that one, right? Yes. Yeah, from there I couldn't remember if I did that one or not, but so you can see, so we ended up doing about 10 to 11 different gold mine companies. We got basic valuations for them. You can see a handful of them are reasonably undervalued. Another handful of them are a little undervalued or close to fair value. And then there's a couple of them that appear to be decently undervalued or overvalued as well. But overall, you can kind of get a picture that miners appear to be kind of cheap. Or at least, it's like if you could assume that the level of conservatism that I kind of painted into these valuations would probably be relatively even, or whatever errors I made in my evaluations of the assumptions I put into them might be evenly distributed, right? There might be like I might have gone a little bit conservative on one of them, but I might have been a little bit generous on the other, and then those ones would kind of balance each other out because they're all minors. So I kind of like assess them on a relatively even basis, and I did all those valuations pretty much within a day or two. So I was kind of in the same mindset, same assumptions, same industry, and then yet we ended up with some companies that are decently undervalued and a few companies that are decently overvalued. So this is kind of like my current assessment of my favorite miners within the mining space. That doesn't mean we have to stop there. If somebody recommended me another gold miner I didn't look at, I would love to take a look at them and compare them against my quality list, and then maybe compare them against my assessments of the other managers, and then maybe I could add another one to the list. So it's like, just because these 10 or 11 doesn't mean that like these are the best gold mine companies that exist. I only assessed like 32 gold mine companies at all. like or mine companies in general. So it's like, I could obviously expand and go much further, and I plan to over time. But the point is, we wanted to get so at least kind of a core list for these industries going. So I have 10 to 11 gold mines here. I already own Silver Corp. That happens to be one of the most undervalued on the list. That is one of the reasons I own it, is because it does appear to be cheap to me. It isn't one of the more quality ones, though. That's one thing that's worth noting, that if we come over here to take a look at the list, Silver Corp did not stack up very well on my quality list. It was just one that I happened to already own. But I think there's a correlation there. It's like, it makes sense to me that the one that is lower quality on the list is one of the ones that has the higher returns, because high risk, high reward, right? So you would expect almost the higher quality ones to be the lower return opportunity ones. For example, Alamos Gold was one of the top quality ones, and it's one of the overvalued ones here as well. But it's not like a perfect even rule, because Evolution was one of the other top rated ones as well, and so that one is decently undervalued as well. So it kind of comes down to like how you look at it, but there's obviously other factors that go into play other than just risk that determines how undervalued something is. Like, for example, Evolution Mining is an Australian listed one, which is why, or for example, you can see here that there's no link here, is because the ticker doesn't actually connect to the correct ticker through Google Finance. So I just typed that in there. And that's why there's no information on this pricing data listed right here, because I can't actually import it from Google Finance because it's an Australian ticker. But the fact that it's an Australian ticker might be the reason that it's undervalued, when the same quality level asset, according to my assessment of Alamos Gold, is or at least decently overvalued. And it's possibly because this one just simply gets a lot more volumes on a regular basis than Evolution Mining does, and a lot more analyst coverage than Evolution Mining does. And so people aren't as aware that Evolution is potentially undervalued. That's, again, just like a basic guess as to why there would be this discrepancy between overvalued and undervalued in seemingly similarly risked assets, according to my assessment. But the point is like, obviously there are these kind of like technical factors and institutional factors that can cause things to be over or undervalued for a variety of reasons. So that's miners. Like I said, I already own 2 of them. I'm not really looking to rush out and buy all the other ones that are undervalued necessarily, but I would like more miner exposure, either more in the ones I already have or more other ones going forward. If Osisko takes some dips, I'll probably be adding to it. If Silver Corp takes dips, I might be adding more to that one as well, but I have added to that one somewhat recently. And then I will be really looking out to see if some of these higher quality ones maybe take some dips as well. I didn't actually put it in here, but this column here does have that quality rating on it. So you can see, like, as I kind of already said, Evolution Mining, Osisko, Orla Mining, Alamos Gold. There we go. Those are the ones that are rated a 3 in terms of the quality rating. So those are the ones I would really be watching and really be paying attention to see if they turn into decent opportunities. Obviously, Evolution Mining is already a decent opportunity, you could say. It's like a 10% COGR already, below a 24th percentile. It has really substantial assets. It really just is the fact that it's an Australian ticker that's really kind of like the one hairy aspect to it. And I did like I did think the management team was pretty decent on that one as well. I don't think it was one of my favorites on the list as far as management teams, but I think it was at least one of the more middling ones out of this list of 10 or 11 companies. So that's the gold miners. Like I said, this is a separate page from the main valuation page on the dashboard. So like, it's currently on my dashboard, which we're looking at right here. But for example, if I was to go over to like one of the other premium dashboards that is available, well, this is the test one, but it's basically the same concept. There is no other second pages yet, but I plan to add that in the near future, probably this week, maybe next week if it for some reason takes me longer. But I don't think it should be hard to add. I've already, the hard part is this right here that I've already done on my page, is like actually just putting the page together. But then I just have to like create a thing for it to import to the other people's pages. But another thing I wanted to note here is down here at the bottom, I also included indices for this industry as well. So I figured it's like, if we're paying attention to the how far above moving averages that these stocks are, as well as the daily and weekly RSIs and the RVOL for them, it might be nice to compare that to how the industry as a whole is doing. So I did actually put a separate technical page together to track that information for GDX and GDXJ, which is the gold miners ETF from VanEck, as well as the junior gold miners ETF from VanEck as well, which are basically the 2 ETFs that people tend to pay attention to when they're trying to see like how is the gold industry doing. So I put those in there so you can kind of get an idea. It's like, oh, my company has good momentum right now, but it appears to be a little bit oversold because it took a big hit in this last week or something like that. Do I want to buy into it? Well, you can see like, oh, how's the momentum in gold miners broadly? And is this overselling connected to maybe overselling in gold miners broadly? And maybe does that affect my bullishness on the gold mine industry generally? Or does that just make me want to buy the dip, so to speak? Like you can kind of compare the two. I figured that would be useful information to have. So that's for gold mines. We can come over to REITs. I've done basically the same thing, but with REITs, you can see over here, I've taken over to the research page first, taking a look at the quality list for the REITs. I had many more variables that I used to assess the quality for REITs than I did for miners. So there was up to 8 points rather than just up to 3 points, which meant that kind of like a median value was more like around 4 and up. So that's pretty close to like what I did. I ended up, for the most part, doing valuations of these kind of like first, what is that? How many is that? That's 14 that I highlighted that had 4 points and up. And then out of the 14 and up, I only ended up doing a basic valuation of 11 of them. So there was 3 of them that I kind of decided to just kind of set aside for one reason or another. But for the most part, we just kind of did those upper quality ones in the REIT list as well. And if you can come over here to see, this is what we ended up with. And then comparing that to the miners, you can see like the miners, I found more miners at least a little bit undervalued than overvalued. If you come over to REITs, it's the opposite. I found the majority of them at least a little bit overvalued, with one particular exception of one that was a little bit undervalued. And then beyond that, a few that were just kind of close to fair value. So just kind of interesting how you can see that, like I said, it's like I did all these valuations for the most part basically on the same day or maybe the next day, mostly in the same state of mind, thinking only about REITs. So I was using basically kind of the same logic, the same methodologies, and the same kind of like process for trying to think about the assumptions. And then yet I ended up with some very big differences in the value, but at the same time, also it just kind of appears that the industry as a whole is kind of moving together, which shouldn't surprise us too much. The fact that we see industries moving together in terms of valuations like that. But nonetheless, similarly, I have the quality number listed here on one of the columns, so that kind of gives me the ability to kind of pay attention to say, okay, well, which ones did I think were the best? Well, out of this list, there's one that really stands out as particularly being great, which is Federal Realty Trust. But then beyond that, there's a few kind of more middling ones. The quality ratings were dropped down to 5 points for the most part pretty quickly. After that, just 8 down to 5, and then to 4, and then there was a lot of 4s, and then so it really just looks like a bunch of 5s and 4s, and then 1 8 on this particular spot here. But nonetheless, 8 isn't super overvalued, and yet we have 5s that are decently overvalued, and then also another 5 that appears to be at least fair value. So just kind of an interesting disbursement between the valuations for REITs. It doesn't look like REITs are a great buy right now, but we'll have to pay attention. Maybe, and like I said, this isn't the end all be all list. If somebody has a good recommendation for a REIT that I didn't look at, I can throw it on the list, because on both miners and REITs, I mostly opted towards looking at the bigger companies first. When I was starting these lists, I largely put them in order of market cap and then worked my way down. So there was inherently a bias towards the larger companies in the way I started this process, in the sense that I only really did the research on like 30 or so of the companies, because it did require me to do very, very company specific research, going through the filings to find specific information, which is time consuming. So I only did it for about 30 companies for each one. And that means it's going to basically be the 30 largest companies, which in some industries that might get you to some pretty small ones, but in other industries that might not get you very small at all. So the point is like this research so far is skewed towards the larger and midder cap size, rather than more towards mid to smalls. I would happily add more small caps to both lists over time. Just in the meantime, I was kind of a little bit more focused on that. Though, like I said, the ones that actually ended up on this dashboard here had to do with which ones were the quality there. So it may not be actually like the large caps. It might be more of like a mid cap blend in that sense. So like, for example, the gold mines, our average market cap is 7 billion. The median market cap is 3.6 billion. For the REITs, we ended up with an average of 17 billion with a median of 12 billion. So you can see it's like, yeah, especially for the REITs, that's more like mid cap kind of territory. Small caps, that's more like small, or maybe on the small end of medium, depending on like where you draw the line. I usually draw a small cap line as five billion and below. That actually is the line in the sand that I personally use for small cap. So you can see like 7 or 3 is literally kind of hovering on either side of it, whereas REITs is solidly within the mid cap range, according to my range, which is 5 billion to 50 billion is how I think about my mid caps, personally. But obviously that's a very subjective line in the sand to have, how where you define small versus mid versus large or whatever. So that's for REITs. Now, like I said, I am looking to kind of take the same approach, the same research, and extend it and do it to several other industries. Right now, in this last week, I've been doing it to utilities. I have already put this kind of utility page in here, but it's not really filled out. You can see, for example, it actually has a REITs listed right here. That's just because I kind of copied the page over. So this is just kind of an empty page, waiting to be filled out. But if we come back over to the research page, I have already kind of done all the research part for the utility. So really it's just, I've done the research part for the assets. Now I need to do the research part on the management, and then also do some of the basic valuations of it. But coming over to that, we can discuss the factors that I chose to use as my kind of quality assessment for the utilities, and you can kind of see like how I came up with things. Now for the miners and REITs, both of them, I was somewhat focused on the geographic location of the assets. That was a kind of an important factor for both of them. The way I treated it for each of them was a little bit differently, because like for the miners, I was very focused on where the actual mines were, the jurisdiction the mines were in, partially because I was concerned about how political scenarios could change over time, especially like the law and tax codes surrounding mines in those areas. So like I had it aggregated based off of the countries they operated in, and then I kind of pick and chose my favorite countries to say that those countries were what I called higher quality versus other countries that I called lower quality. And that's how I treated it for the miners. Whereas for REITs, I was much more focused on US REITs. I was fine with REITs that had international exposure, but I still wanted them to be US companies for the most part, or be US based for the most part. But the point is it didn't really matter about the country so much, because it mattered more about the regions of the United States itself. And then I just kind of had international as its own separate bucket for that as well. But for utilities, I kind of took the same approach as I did for REITs, where it's like I'm focused primarily on US utilities. I have some interest in some other countries' utilities, but though my interest in those utilities has less to do with my interest in the utility and has more to do with my interest in the economic environment of that country itself. And then I find the utility sector to be a good way to play certain economic environments in certain countries. So like if you have a bullish thesis on a certain emerging market, for example, in my opinion, buying a utility company in that emerging market is actually a pretty decent play on the economy as a whole, rather than making a play on like a specific industry. Obviously, utilities have their own specific factors to it, but the point is, if an economy broadly is growing, utilities broadly are going to be growing. So it can be a good proxy for a macro kind of play, not necessarily a company specific type of play. But either way, like I said, here I do have a thesis where I'm interested in utilities specifically, and that has to do with me focus more on the electrification theme, and focus on the fact that people need to expand the energy supply, especially here in the United States. With utilities, we're kind of using the same approach as we did with REITs, where we're focused more on the regions of the United States. I have it separated off into Southwest, Southeast, Northwest, Northeast, North Central, and then I do have an international segment as well. Dan, welcome to the stream. Notice you just popped in. Glad to have you here. Showing up a little bit late, no problem, no problem. It was a little bit of a last minute impromptu kind of decision to go live anyway. So no worries, no worries. But anyway, so beyond the geographic location of where the REITs are, that's just one factor that we're taking into account when trying to assess the risk associated with them. But then we also wanted to take into account like what type of utility is it. There's different type of fuel sources, whether it's nuclear, natural gas, solar, oil, wind, coal, hydroelectric. You know, there's all sorts of different power sources, and depending on your own biases or your own views of economic trends going forward, you might have certain preferences towards certain fuel sources. This gets very subjective on which ones you think is more important than others. But for me personally, I have a pretty strong preference towards nuclear. I personally think that nuclear is like the most logical energy source, and it's honestly ridiculous that we haven't expanded the nuclear power supply globally, in my opinion, much more than we already have. And that's, in my opinion, in the future, people will start to move towards it over time. It'll take time for it to happen. I don't think this is something that's happening very quickly, but I do think over time people are moving towards nuclear because it is just the obvious choice, once you kind of work out all of the kinks and all of the difficulties surrounding it. But then beyond that, I find natural gas to be a very, very efficient fuel source as well, especially here in the United States. Solar is pretty good beyond that. Then I start to kind of bucket coal after that. I didn't have a specific grouping for, or not coal, I said oil. I don't have a specific grouping for coal, but I actually, in many cases, kind of like grouped oil and coal together as kind of like the dirtier end of the fossil fuel supply, if that makes sense. And then wind, I actually have below that because as quote unquote renewable as wind is, in a fuel sense, it is not very it's not very efficient in a materials technical sense, in my opinion, from what I understand of the manufacturing of the devices. And then I have another bucket as well. And a lot of these are estimates because for some of these companies gave very specific estimates for how and what type of fuel sources that they use, but the others were very vague on it. So there's a decent handful of companies in here where I kind of had to make some best guess estimates. But nonetheless, that's kind of what I ended up working with. And then we gave them kind of extra points depending on which one they're in, and then gave them a rating based off of that. Um, Dan, most recent comment there. As an American, what difference it has been between Southwest, Southeast, Northwest, Northeast, and North Central? Now, as I mentioned when I first started going into that, it's very subjective. Another American would probably give a totally different opinion on which ones are better regions to operate in. I just chose to section off the country this way, and also different people might have used different terms and different groupings or whatever. There's many different ways you could choose to like group off the United States, but the Southwest United States, which is like the southern half of California, in my opinion, to like the western half of Texas, and then Arizona and New Mexico in between, and then I would even sort of count like the lower half of Nevada, the lower half of Utah, and in there as well to a certain extent, is like that kind of like lower section. Like to me, in my opinion, that is one of the most popping parts of the country in an economic sense. Like I expect strong population growth there. I expect strong wage growth there. I expect strong rental growth there. I expect strong business growth there. I expect basically the economy as a whole to expand strongly in the Southwest United States. That's based off of my own personal views from other research I've done in other areas, and it would take like a lot to kind of like go into all the details of why it is that I'm bullish on the Southwest region of the United States. But I personally am very bullish on the Southwest region of the United States, and so for me, that ends up getting kind of an extra boost on this qualitative rating because of that. But like I said, if you asked some other American that lived maybe on the Northeast, they might have the complete opposite opinion of that. Because like for example, like I ranked the Northeast not super high. And that's because I don't, for those same reasons that I thought the Southwest is good, I think the Northeast is weaker. I don't think they're the weakest. I think the North Central region is the weakest region of the United States to operate in. That's why it's the lowest out of the grouping on this list. And then international ends up just kind of being last, so for that one region. So yeah, it's just one of those things where I'm picking and choosing the regions that I personally think have the best economic dynamics in them. But somebody else could easily come up with a different order of regions in the United States. This isn't like some universal thing where it's like, oh yeah, every American will tell you that the Southwest and the Southeast is the places to be. It's just me personally. I think the southern half of the United States is the place to be. So those are the two best regions to be. So those are the kind of like those two first main categories. Then beyond that, the other assessments of quality that I use for utilities, it gets a little bit more complicated. It gets a little bit more in the weeds. There's generation capacity. How many megawatts of generation capacity do these utilities supply? So it's like, the way I think about it is like, you want a utility that has strong power generation, because if their demand starts to spike up, if people are demanding more energy from them, they have to be able to supply that demand in order to be able to get the revenue. So the more capacity that a company already has, the easier it is for them to fulfill that demand. So We want high levels of capacity. Then there's transmission miles. There's the miles of circuitry that has to exist for them to be able to transmit this capacity to their customers, right? So you want them to have a large area. You want them to have lots of customers, but you don't want them to have lots of miles of transmission lines, because that's essentially more equipment that has to be maintained over time, right? So you want high capacity, but you want low transmission miles. Then you want high customers, right? You want to have a significant amount of customers, because your customers are obviously the people that pay you. But you don't want to have more customers than you want to have generating capacity before, right? So you want to have a high number of customers, but you don't. But you want to have more capacity than you need to satisfy those customers. So, for example, you want to have strong capacity per mile, since you want to have strong capacity and you want to have a low number of miles. So the ratio of capacity to miles, you might want to have a high ratio of, and that's one factor we chose to assess. Then you want to have high generation capacity, but you want to have maybe a low number of employees, because employees you have to pay, right? So the capacity to employer ratio would be something that you could compare as a kind of a qualitative aspect for a utility. Then you want to have a high number of customers, but you want to have a low number of employees, because essentially is like, how many customers do you have per employee, because that's how many people are paying you versus how many people are you paying, right? So the ratio of customer to employee would also be something you might want to pay attention to. So you see like how I came up with different ratios using these different non-financial measures. I used generation capacity, I used transmission miles, I used customer count, and I used employee count to come up with these different ratios: generation capacity per mile, generation capacity per employee, customers per employee, and then I also used revenue as well. So I did actually use a financial measure here for a few of them, where I looked at, okay, well, let's see what's the dollars of revenue that they charge per capacity, per megawatt of capacity, right? It's like, how much are they charging per megawatt? So we have the dollars per megawatt here. Then how many dollars per customer that we have? We want high number of dollars. We want high number of customers, but we want to be charging a high number of dollars per customer, right? So dollars per customer, and then we combine all those together. So generation per mile, generation per employee, customers per employee, dollars per generation, and then dollars per customer. Those 5 metrics all in together essentially teases out all of those different metrics in a way that gets it so that we have things high where we want them to be high, we have them low where we want them to be low, or we have things higher than another thing where we want them to be higher than another thing. A little bit complicated to kind of get in all the details there, but like I said, it's like we had to dig through like 30 different annual reports to find all of these metrics for all of these different companies. So it took a while, worth of the juice, I think, in the end of the day, because then that means we're going to have relatively efficient companies on our high quality list here. It's going to be companies that have lots of customers, but have lots of capacity for those customers. They have not that many employees relative to the amount of customers that they have, and they don't have that many miles of transmission wiring relative to the amount of capacity that they're trying to deliver to their customers. You can kind of see how all those things work together. Dan, I'm kind of a utilities hater, but I'm loving the live stream. Very good to listen to you talking about it. This is a corner of the market I have never bought any stocks, so I don't know much about. Now, I'll be honest. I've been a big hater of the utility sector myself, to be honest. I have owned some utilities in the past. I've actually made some pretty good returns on utilities successfully in the past. But for the last few years, I have shied away from them pretty significantly, because I had decided that I didn't like the sector because of how regulated it is and how that affects the amount of returns you can get and how capital intense it is. And also, generally speaking, I find them to be very expensive. They don't tend to be very cheap. So I definitely understand reasons why somebody wouldn't be a big fan of the utility sector, and I still hold all those opinions, generally speaking. But as I've talked about several weeks ago, when I was kind of like getting into my framework around this kind of like thematic way to looking for stocks, I was saying it then and I'm saying it now, that the goal with this isn't really to find something that is cheap now necessarily. Like, if I could find something that's cheap now, that would be great. But the goal is really to build these lists that I'm just going to watch and just wait for. So I have my list of gold miners I'd like to own, and I have the valuations at which I think that they're potentially a decent value. And I'm just going to wait and watch. Some of them I already bought because this particular list that was had some better value in it than some of the other ones. But like, for example, the REIT list did not yield me very good value results. I've narrowed in on a bunch of REITs that I think have reasonably good qualities to them. I narrowed in on which ones I thought I had good management teams to them, and I came up with some good valuations for them, but they're not really at a good valuation yet. So now they're just going to be watched, right? I'm just going to have this list here, and I'm just going to be waiting and watching. So it's possible that utilities will be in that same bucket. It's possible that when I'm done with this on the research, I'll find that all of them were a bit pricey for me, because they have limited upside because of the regulations and whatnot. But the point is I want to have the list. And the reason why I've become a little bit more bullish on the sector, generally speaking, bullish on them from a fundamental perspective, not bullish on the stocks. Because like I said, the stocks in general, I do think tend to be a bit pricey. Like for example, right here, you can kind of like skipping to the end of the discussion, you can see that 5 points and above is what ends up getting tagged green here. So those are the ones that I decided were the higher quality ones on the list. Here is this top 11 here that were scored 5 and above. And I actually took this next column here where I showed the EV to EBIT ratio for all 11 of them here. And the median EV to EBIT out of those 11 is 20.5. 20.5, almost a 21 on an EV to EBIT for on average for the higher quality utilities. So you can see they're not that cheap. There's a couple in there that are cheaper than some of the other ones, like, 17.8, 17.6, 18.1. So, obviously I'm kind of maybe hoping that those ones look a little bit better than the other ones. But the point is like, once I'm done with this research right here, I might not find anything of value right now. But the point is who knows? Maybe some news happens after earnings 3 to 6 months from now, and one of them dives 20%, right? And then that'll be my opening. I will already have done all the research. That's the thing I'm trying to change. I know I've kind of said it. I said that several times in the last several live streams, but it's like the thing I've done a lot of in my investing career so far, and I see lots of other retail investors do this as well, is they're just watching their portfolio and the market's open, and then a stock starts to crash, right? For one reason or another, there's some news or something. Some stock just drops 25% some day. And then suddenly all of the retail investors are all of a sudden talking about that stock. It's just all of a sudden, everybody's got to talk about this stock that dropped 25% today. What do you think about this stock? Is it a buy? Is it a buy? Oh, it dropped 25% today. Are you going to buy it? Are you going to buy it? I don't know. I don't think it's a buy. I kind of want it to drop 10 to 15% more. No, I'm going to buy. And if it drops a bit more, I'll buy a bit more. You hear people talking like this, right? Like, stock drops 25%. Everybody now suddenly has an opinion on that stock. But how many of them had an opinion before the stock dropped? That's the thing that I'm trying to fix. I'm trying to make it so that I have a more solid opinion of high quality assets down to the value that I think they're worth before they are actually in that dropping position. I don't want to be trying to scramble to decide what I think something's worth after it's already dropped, because I think that puts you in a position to be much more biased towards trying to make the valuation work. Because if you see something's dropped 25% today, you're like, you want to buy it. There's a part of you that just wants to buy it. And so you're going to change those assumptions until it gives you the valuation that you want, and so that you can buy it. And so that's what I'm trying to change. I'm trying to make it so that instead I'm setting up the lists, I'm setting up the stuff that I would like to own, and then I'm just kind of waiting for it to come to me. I'm waiting for to use the sports analogy like everyone always likes to do. I'm just waiting for that pitch to come right down the center of the box in my strike zone, right? That's what I want. That, a lot of the big investors have always said that, like, that's the way you're trying to do it. So that's kind of the approach I'm trying to shift towards. So with utilities, who knows? Maybe that'll be what I'll do. Maybe I do all this work on the utilities, and I do my basic valuations on these top 11 here, and then none of them look like a value, and then I'm just waiting for a while. Who knows? Maybe I wait forever, and maybe I never end up with a utility. But I will say, Dan, the reason that I have become more bullish on utilities has to do with my views around the power supply in the United States. I've talked about that a lot. I do think the power grids are very weak here. They lack a lot of repair infrastructure that they've needed over the last 40 years or so. Like we have a huge power grid here in the United States. We have a massive demand for electricity, and that demand is only growing. Has a massive tailwinds to the growth of it for the next decade or so. But we're behind on our maintenance to a massive degree, which basically puts us in a position where a lot of utilities need to do a significant amount of capex in order to provide that demand going forward. So obviously you don't want to be in a company that has to do a huge amount of capital expenditures, but you can alleviate that by choosing one of these higher quality assets, because some of them have done a better job of being on top of all of that maintenance than others. And so the idea is that if utilities in general need to expand their asset bases, if you could pick and choose some of the ones that have already expanded their asset bases a bit more and are maybe in some of the better jurisdictions from a regulatory standpoint, then that can actually get you in a position where you can get excess returns, even if maybe they're not super cheap. Maybe they're not super cheap, but maybe they're at least not super expensive. I don't know. Like I said, we'll see what results I end up coming up with, because like right now I'm still in the like I said, the asset quality stage. We haven't moved on to the management assessment and the actual valuation assessment part. But anyway, so I kind of talked about those main kind of like 5 factors that have to do with like different ratios of metrics back and forth with each other. But there's a few other metrics in here as well that we need to talk about. I did include the S&P credit rating, which I included for the REITs as well. That was something that I included as one of my factors for the REITs, because debt financing is critical for real estate operations, but it's also critical for utility operations for the exact reason I just explained, which is that they have to expand their asset bases, which is a lot of infrastructure spending, which is very often debt finance. And that kind of carries us into the last of the factors, which is the allowable ROE. And that's actually kind of relates back to the debt level thing, because that has to do with how utilities are regulated in the United States. The way utilities are regulated in the United States is that they regulate both the allowable return on equity that a company can receive and the allowable equity financing that they can use in their capital structure. And what that does between the two is it kind of creates a limit on what type of growth in the rates that they can charge their customer. So it's like if you're allowed a 10% ROE and you're only allowed to go up to a 50% equity financing, then that means that you can only charge a 5% return on capital to your customers at maximum there. A 5% return on capital to your customers, net out inflation of say maybe 2% on that, and that ends up being like no more than a real revenue growth of 2 to 3%. So you can see how like these regulations tie into each other in a way that makes it so that utilities don't charge massive amounts higher year over year relative to what they did previously. Or if they are going to charge higher amounts, they have to go to the courts and they have to get these they have to get approved for a higher ROE level, or are approved for a higher equity financing level. So I have the allowable ROEs here in this column as well, because frankly, we would definitely like to invest in companies that have managed to convince courts to allow them to have a higher ROE, because that basically means that they can capture a much larger chunk of the return relative to their customers. So those factors all in together are the factors that we're paying attention to for utilities. They add in all together on this column right here. And as I kind of already gave the game away a little bit, obviously 4 is the median level here. So 5 and above, 5 points and above is the higher quality assets number to hit according to this assessment, which gets me these 11 companies here on the right hand side, which is basically around what we're trying to do. Is like I said, we're doing this assessment for around 30 or 30 plus companies, because 30 is a good sample size. So that means that our statistics will start to be somewhat useful. But then once we're there, we're really just trying to cut it down to like a relatively short list so that it can go in these watch lists I'm building. So I really only want to have like about 10 or so to put in each of these. 10 to 11, that's fine by me. And then even these lists of 10 to 11, the goal is to probably over time actually cut those down as well to maybe more like 5 or 6 or something like that. Because like I did do some, like I said, I did do some management assessment for the gold mines, and I kind of got like halfway through the management assessment for the REITs. But the point is like ideally I would maybe like to try to like narrow in on the best of the best and really only get 5 to 6 or something into these lists. And the reason why I say that is because like frankly, I want to do this for many industries. Like I've already done it for gold mines, I've done it for REITs, I am doing it for utilities, but I also want to do it for home builders. I also want to do it for railroads. I also want to do it for electrical industrials. I also want to do it for employment and consultant firms. I also want to do it for agricultural commodities. I also want to do it for building and construction materials. Like there's a whole list of industries I kind of want to do this approach for. And as I do that, that's going to be more stuff being imported into these dashboards, which more stuff that gets imported in the dashboards tends to slow down my dashboards a little bit. So that means like as I start to put more and more industries into this process, it might start to get a little clunky, which means I might want to thin it down a little bit more. So if I can go from the 10 to 11 list down to a 5 or 6 list for each of them, that would theoretically double the amount of lists that I could maintain. But we're not really having problems with that yet. So that's just me being aware that that might become a problem in the future. But in the meantime, like I said, we'll trying to get like 10 to 11 or something for that. So we've got our 10 to 11 utilities we're going to look at. I'm going to start doing the basic valuations here probably right after the stream. That's probably what I'm going to do for the rest of the day, is just do some basic valuation work on these utilities and see what I come up with. And then after that, I'm going to move on to the home builders. So yeah, that last comment there from Dan. Here in Brazil, utilities is a retail investor favorite. People love the dividends. Utilities companies are quite generous with their dividends here in Brazil, but me personally, I've never been a fan. Also, dividends are tax-free in Brazil, so that helps. Yeah, I remember you mentioned the tax-free dividend detail a couple times before in our discussions, which is interesting, very, very interesting. And I will say, it's like I do think that there's kind of an interesting parallel. I think in one of our private conversations, I may have talked about it a little bit before, because like Brazil in many ways is kind of like going through like their phase of economic development where the United States in many ways kind of was like 100 years ago. Like obviously technologically they're still kind of in the same pace or whatever, but I mean in terms of like development of the economy as a whole, where they're still very focused on trying to build out a lot of infrastructure to different other regions of the country that just haven't been developed nearly as thoroughly as others. Partially just because obviously there's the Amazon's in the way. It's kind of makes it difficult to develop a country when you have a gigantic rainforest right there on your side. But the point is they're kind of in this space where they're constantly trying to develop the railroads, constantly trying to develop the utilities, and develop their financial infrastructure as well. The reason why I bring up that parallel is because those stocks were the favorites of Americans back during those time frames as well. So like I think it's kind of like an interesting parallel where it's like you right now utilities are a favorite in Brazil and they're a big dividend payer, which kind of reminds me of when utilities were a favorite of Americans, which was more like earlier in last century. And obviously they're still big dividend payers, but the point is they were the big dividend payers back then too. And it was just seen as almost like as good as gold. Like utility stocks and utility dividends in particular were considered just like a guarantee. Like those utility stocks, they were going to pay those dividends, thick or thin, and therefore it was like a for sure bet. Obviously, that's not necessarily the case, and they become much less popular over time, partially because people got disabused of those that worldview in certain crises. And also eventually the growth stops too. It's like, as I kind of mentioned before, so utilities can be a great way to play an expanding economy in general. So if your economy is expanding fast here in Brazil, which in general it has been expanding fast in Brazil relative to say like the United States or other developed markets, then utilities is going to be a pretty for sure bet. But once that growth starts to slow down a lot, utilities are going to become a lot more of a hairier bet, a lot faster. So yeah, it's just one of those things where the phase of economic development that a country is in can definitely lead to some more obvious preferences for certain sectors over others in the retail kind of investor community. Yeah, yeah. Retail investors in Brazil treat it as a for sure thing, he says. Yeah, doesn't surprise me at all. It's just like a for sure bet. It's like, oh yeah, those utility stocks, of course they're going to pay their dividends. But then who knows? Maybe like 10 years from now, you guys might have like, well, I mean, I say you guys, but obviously you want to move away from Brazil. So for 10 years from now, you might not be in Brazil anymore. But 10 years from now, Brazil might have some like big crisis in their infrastructure sector or something where something goes terribly, terribly wrong, and the government decides to essentially put all the blame on the utility sector. Maybe they deserve it. Maybe, I'm not necessarily saying they don't deserve it, but the point is like maybe they throw them under the bus, and then suddenly all of the shareholders to utility companies gets uh, dramatically wiped out, and then suddenly everybody hates utility stocks going forward. It's something like that could totally happen. But you never know. Like those types of things happen. It's like people see something as a for sure bet until it's not, and then suddenly people have a different opinion of it. Because like people here in the United States used to treat. In fact, I think this is one of the areas where I was talking to you about this before. I think was we were talking about bank stocks, and I kind of said the same thing about bank stocks, where it's like bank stocks in the United States used to be thought of as like a for sure thing. A lot of people used to be like, oh yes, bank stocks. Let's you definitely want to have your financial stocks, get those bank dividends. They're for sure things. But ever since the financial crisis in 2008, retail investors and institutional investors as well tend to be much more scared of financial stocks. So it just shows that all it takes is a specific crisis in a specific area for everyone's opinion about a specific sector to completely reverse and go completely the other way. But anyway, I digress. Back to utilities. So yeah, we have our list of top utilities. I plan to start doing some research there on these in the near future. We'll see how it goes. I will point out that SO, this one right here, Southern Company, that is one of the utilities that I made good money on in the past. So happy to see that they're in the higher quality list. It doesn't surprise me that they're in the higher quality list, actually, considering where I know they do their business and what type of power generation they use. So it doesn't surprise me that they at least had those two factors working in their favor. I didn't necessarily know off the top of my head that what other factors that they would have working in their favor or not. But the point is, it was at least enough of them to get 5 points. So good on them for that. Though they're not necessarily one of the cheaper ones. So we'll see how that goes. Yes, Dan. Yeah, you've been on a bank buying spree in the United States lately. Although I think that's probably working out pretty well for you, at least recently, right? Like banks have been supposedly doing pretty well in the last few weeks, from what I hear. I haven't been looking super closely at them, but I know I heard the financial sector was the single largest jump out of all the sectors in the United States after Trump was elected. I know people were talking about that because like a lot of people, like obviously tech went up a bunch and materials went up a bunch and real estate went up a bunch, and those ones didn't surprise anybody. But the bank ones that actually did surprise people a little bit. Um, Dan says, I think you Americans are too pessimistic, fearful towards banking nowadays, but yeah, you have a good historical reason to be. I'm mixed on it. And I'm pretty sure I've shared this opinion with you before as well. It's like I do think people probably are too pessimistic on them because yeah, they might be too cheap because of the fact that people have kind of just like thrown them out a lot over the last 20 years. But I do think that financials are very complicated, especially here in the United States. Maybe in other countries it's a little bit less so. I don't know. I don't really look at financials in other countries that much. But financial stocks are very complicated. So it's one of those things where it's like it doesn't necessarily make it a bad company. Like it doesn't mean you should be pessimistic towards the industry. The industry might be fine. But you should only invest in things you understand, right? Like that's the thing that everyone agrees that you shouldn't be investing in things you don't understand. So even if people are maybe too pessimistic about banks just because they're a bank, banks are still complicated. So I would still say that I think the average retail investor probably shouldn't be invested in banks that much. Or if they are invested in banks, they should really, really try to take their time trying to really get to know one bank in particular. Because I don't know, this is from my own experience with financials. Like I say this partially off of like, because like my portfolio, my top position is FG annuities and life. That's not a bank, but it is a financial stock. And let me tell you, I've held that one for a few years now, and like it's a segment within F&F which I've held for even longer. So like I've been paying attention to this company now for like 4, getting close to 5 years. I've been paying attention to that business, and it's complicated, and there's a lot of little details to it, and I think I understand it relatively well. But there's still like lots of little like finer details to it where I'm kind of just assuming that isn't a big deal. Like that, I'm not an expert in every detail of how insurance works. And that's what that is. It's an insurance company. It's not a bank. It's an insurance company. But insurance, I would put in that same camp where it's like insurance is complicated. On one hand, you can kind of easily describe how insurance works in a very simplistic way to people, and then be like, okay, it's not that complicated. But the actual mechanics of like interest rate hedges, and using swaps and options to maintain exposure to equity, and balancing out withdrawals on your deposit base versus the costs of capital. It can get a little complicated, and I definitely think a lot of people oversimplify. I mean, I think a lot of people oversimplify all of investing, but financials in particular, I do think are a bit complicated. Doesn't mean you should avoid them. It just means that you should spend a lot of time getting to know the company. Yeah. So, because like my top position is a financial company, so I'm saying that I think financials are complicated and people should be very careful when they're investing in them. But my top position is a financial company, so I say that partially just because of my experience with trying to research that company and being like, wow, I understand what's going on here, but there is a lot going on here. That's kind of where I'm at with that. So that's pretty much it that I really had to talk about here today. And it was going to be a relatively short one. I just kind of wanted to give you guys a quick update on what I was doing with utilities. I kind of felt bad for not streaming last week because I said I was trying to stream every other week. So my goal is to stream this Friday, because I was trying to do it every other Friday because I have a bunch of Fridays off at work recently. So next Friday I do have off. That's the day after Thanksgiving here in the United States. So it'll kind of be a post-holiday stream thing, which means maybe some of the Americans might not show up or whatever, but I don't know. Obviously I have a decent amount of viewers that are not American as well, so you guys might show up anyway, regardless of that. But yeah, so you can expect me to stream next Friday. My goal is to hopefully have made some serious progress on the basic valuations of the utilities. I don't know if I'll get all 11 of them done, but it'd be nice if I get all 11 of them done. But I also want to start getting some work done on the builders. So like if you look here down here on this research page, I do have at least the lists going for many of the other groups I was talking about. So I have builders, I have railroads, I have employment service companies, I have electric industrials, materials, paper, defense, aerospace, hardware, IT. So like you can see, like I've just made lists of tickers. Like here, I just have lists of tickers in different industries. I haven't really like started doing the actual qualitative stuff yet. But the point is I was at least getting the list going, and builders is where I'm going next. So I might even do a little bit of that here today, where I might start going through and putting together some factors that I think can help discern the quality within this sector as well. But yeah, so by next Friday, I hope to at least have made progress on like maybe half of the utility companies with the basic valuations, but it'd be nice if I got all 11 of them done. But at least half of them I plan to try to have at least done. But I would also at least like to have at least like the core start of the builder list going as well, if not maybe a lot of it going. So we'll talk about that on Friday. So with that, I'll say, if one more time, if you're watching live or on the replay, it'd be really appreciated if you'd like the stream. More likes really helps attract more viewers to the channel. If you haven't already, please subscribe to the channel. That way you get notified whenever I go live. Pinned comment in the chat, as well as in the description below, you can find the link to the Discord. The Discord you can join for free. It does take a few hours to up to a day for somebody to let you in manually. So be patient when you do join. You won't be able to really see anything when you first jump in, but somebody will let you in within a short period of time. Then you can kind of be part of the regular discussions of what we've got going on in our own portfolios, of things that are happening in the market, actions of our favorite investors and stuff like that. So come be part of the discussion there. And then also, if you do join the free Discord, here on this link here, you'll find the free valuation dashboard. So you can come and get access to this link here, which gives you at least the main page where I have all the valuations for the main models that I've shared here on the channel. So if you want to see how those valuations change over time, you can see that list on any given day. This is a free to access link for anybody. Like I said, you just have to be part of the Discord. So join the Discord and you get access to the free link. But you could also pay for one of the premium versions of the link. That way you can get access to these back pages for the industries, as well as the valuation information as well. So $5 a month if you wanted to join on PayPal or Patreon or any of the other ways that you can choose to pay. That's what it is, $5 a month if you're interested in that as well. So with that, I will say that's it for today. Thanks to Dan for coming to be part of the discussion. He was pretty much the only one that joined me today, but that's okay. Like I said, it was a little bit of a last minute stream. So I'll catch you all next week.